Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm really excited to be joined by Thomas DiFazio. Thomas is a director and research analyst at the firm, and we're going to talk all things asset and sector allocation today. But first, Thomas, how are you doing today?
I'm good, Ross. How are you? Hope you had a good fourth.
Yeah, doing really well. Appreciate it. Hope you did as well. I want to start. You do a lot of work on the sector and asset allocation projects with the firm, and let's start high level asset allocation. What are some of the need to knows for how Strategas is thinking about asset allocation, and maybe any recent changes that stand out to you?
Yeah, absolutely. What our team tries to do every single month is evaluate three tenets, and we talked about this the last time I was here. First one being is that we are looking to see the market arrest the levels of inflation, the elevated levels. Number two, we're looking to bring valuations of the market to a more acceptable level given those levels of inflation as well as interest rate levels. And then we're also looking for organic drivers of growth. Now, in the latter half of 2022, when we were looking at these three tenets, we were 0 for 3. Now, in July of 2023, we're making progress and we're getting there. Inflation has come off of its peak level of roughly 9%, and we're in the 4% ballpark. But there's still work that needs to be done. On the valuation front, frankly, valuations have expanded even a little bit given the market's run up and the persistent stickiness of earnings estimates. So still, there could be some work to do. We're not as thrilled with the valuation levels of the market, but that remains unchecked. And then lastly, organic drivers of growth. This one has proven more elusive than not that we'd expect, but it's just proven more elusive given the difficult operating environment. And as a whole, we know that AI has now become the rage and has been a hot topic for investors. And I think it remains to be seen whether AI can be that organic driver of growth over the long run that we need.
Yeah, I think that's right. We're in the early innings there, especially on whether it can be a big, kind of economic and productivity enhancer over the long term. So while maybe, not enough yet to convince you all to be a little more optimistic on the market writ large, I know you made a change to the technology sector recently, and maybe that's timely talking about AI here. Could you give us an update on the tech sector?
Yeah, absolutely. So I just want to preface it by saying AI we do respect as a durable long-term theme, but we just wonder if the sector is mature enough and potent enough to help save the U.S. economy from a recession. So that's really where our head is at on that space. As a whole, we upgraded the technology sector from an underweight to a neutral weight. It's hard to argue against the fact that these big bellwether companies such as Apple, Microsoft, Nvidia they had an extraordinary run in the first half and led to the NASDAQ 100 having a almost 40% run up in the first half of 2023. And we recognize that going from underweight to neutral may seem like performance chasing, but we do want to respect the price action and respect that there are some fundamental changes going on underneath the surface. That being said, we're also still neutral and not more bullish on the sector going forward because we expect absolute and relative performance to cool after such a strong first half in 2023. And when you pair it with the fact that you're starting to see the Treasury general account starting to get refilled, we do think that there's going to be a liquidity drain that could impact a more durable and longer term bid for the technology sector and would hamper that ability for the sector continue to outperform at the clip that it has been in the second half of 2023.
Yeah, it's been a tremendous run to be sure, and it has soaked up most of the storylines and narrative for the market. But I do want to talk about one other sector that has maybe not gotten as much shine, but has been one of the better performers outside of the AI adjacent kind of tech space, and that's industrials. So global industrials have been resilient. It's been a broad-based rally, and I'm wondering if you all have any thoughts or have made any changes in that sector as well.
Yeah, absolutely. Industrials have been another poster child of a wonderful first half for certain pockets of the market. And like you said, the performance is broad-based. It's domestic and it's global and it's outperforming. The overall sector has been wonderful. That being said, we're remaining neutral. We do still think that the risks to the downside outweigh the risks to the upside. We do still think that there's an elevated risk of a recession. And this is while we recognize that some of the fundamentals have improved within the sector. You have seen producer prices come down, which has helped address a margin issue within the sector. You've had supply chain issues. Now it's completely evaporated. And it's easy to say now that COVID is over. You don't have supply chain disruptions to the degree that we had a couple years ago. That being said, there is still an elevated cost growth that is impacting companies and really where you need to start to rely on the high quality operators to act in this environment. And as a whole, this is leading us to really just to try to tamper our expectations on the sector as a whole. Another key indicator that we're watching is the Strategas leading indicator of manufacturing, our SLIM survey. Our SLIM survey for new orders trended up over recent months, but is now pointing lower again. And we think that this could be a harbinger of more difficult times to come within the sector, and just shows that all of the fundamental headwinds haven't really cleared yet. Ultimately, we're neutral, and we try to let our work give our investors options on both sides. One of, I think, the most interesting studies that we did was one of our factor studies, where if you believe that PMIs are going to continue to trend lower, then you should look at high quality operating companies that have high margin, high return on CapEx, and so on. If you're believing that PMIs are going to go higher from here, then look to more of your, you can look to some of the lesser quality companies, but ultimately low valuation industrials companies are the best way to play that. So we remain neutral as a whole, but there are ways to play both sides depending on where your team lands on the research side of things.
Thomas, that's a tremendous update. A couple great sectors to keep top of mind as we head into the second half. Thank you so much for the time today.
Yeah, my pleasure, Ross. Thanks for having me. It was a pleasure.